and gentlemen, markets are crashing today. This is absolutely hilarious because we expected this would happen, okay, in January, not during the Santa Claus rally period in 2024. Okay, so let's explain what's going on today. And unfortunately, there's not a whole lot to explain this. There is some economic data that came out today, but nothing that really explains why the VIX is up 19%. The Russell is down 2.23%. NAS is down 2%. S&P 500 is down 1.5%. And the Dow is down over 1%. There's some geopolitical things happening today. The South Korea has impeached their acting president, Han Duck-soo, deepening political turmoil. Although I don't think this, I guess, is the thing that is causing markets to fall. Some people are pointing to the data that came out today. I don't think that makes sense either. So you're really going to want to pay attention to why markets are falling. You have the goods trade balance of a negative 102.86 billion. Consensus was 100.7 billion. Wall Street doesn't really care about that. Retail inventories month over month came in at 0.6%. We were expecting 0%. Now, if you recall Q1, Q2 of 2022, we were in a recession really driven by inventories. But it's one of those things where, have you ever heard of Wall Street caring about inventories since then? No, and even during Q1, Q2 of 2022, people really didn't even care that GDP was negative because of inventories, okay? They cared about the Fed raising rates and everything else. So that's not what is causing this sell-off today. Not at all. Wholesale inventories month over month came in at negative 0.2%, kind of as expected, as your retail inventories excluding autos came in so strong. Now, let me tell you why markets are selling off today. This is going to be kind of hilarious, okay? Because we just talked about this in the last video. I expected that big tech would sell off starting in January. Okay, I said this in the last video as clearly as that. Big tech was going to sell off in January. Instead of in January, it's happening now. Okay, the repositioning, the first phase of repositioning is happening today. How does repositioning work? Well, when markets are mainly just driven by algos, when big tech sells off, everything kind of sells off. Okay, and that's what's happening today. Big tech is being sold because big tech is trading at astronomical valuations because they're not growing. Okay, so Apple trading at 30 plus times next year's earnings, and they've grown 5% in 3 years. Essentially, they grow like 2% a year. You know, does that make sense? No. Okay, 2025 is going to be about AI appliers. It's going to be about small caps. It's going to be about data centers. Could be about crypto. That's a toss-up. It's going to be about small caps, about cyclicals and value, but not about big tech. So what's happening? Big tech's being sold, okay? The repositioning has started for 2025. What's also happening in other areas like the RSP, the equal weight S&P, which is way outperforming, okay? The RSP is down 1% today. S&P is down 1.5%. Again, NASDAQ down 2%. Even the Russell down about 2.5%. The rest of the markets are still being, get this, tax loss harvested. Okay, so you have this deep positioning out of big tech, and you have tax loss harvesting at the same time. That is causing kind of the broader market sell-off, where everything's kind of selling off. Now, I think big tech is going to sell off further from here. So that could mean maybe further downside. But at some point, it will reverse. I think as we start 2025, obviously the tax loss harvesting goes away. And you're going to see the broader markets really rebound. And big tech could continue to fall. That's why I said literally in the last video, there is headline risk to the S&P because of the market cap weighting in big tech. So just for context, Apple's down 1.5%, Meta's down 2%, Amazon's down 2%, Microsoft down 2.5%, Google's down 2%, Nvidia's down 2.5%, Netflix is down 2.2%. Okay. Imagine if big tech looked like this tomorrow, but the rest of the markets were up like 1%. Because of the market cap weighting in big tech in the S&P, it wouldn't even matter. The S&P would still be slightly red or down, right? It would be down or maybe break even, right? Because of the overweighting in these big tech names, okay? So you could see a broader market rally in January and the S&P may still fall depending on how much big tech falls. And that is, I guess, the issue at this point if you are an indexer. That's why I gave the warning in the last video to the indexers. Because, I mean, I think you're going to see a lot more selling in big tech because big tech's not really growing much. They have high expectations, lofty valuations compared to small caps, compared to value, compared to cyclicals, which are expected to grow faster than big tech next year. Now, expectations versus reality, who knows? Maybe big tech grows faster. I have no idea. I doubt that. We've seen crazier things, though. So, from my perspective right now, it looks like people are kind of just tax loss harvesting and depositioning in big tech at the same time. And that is what is causing kind of the broader market sell-off because there's nothing else to explain what's going on in markets. And it's kind of just a head scratcher. Now, it's so bearish, it's bullish. Okay. CNN's Fear and Greed Index today is at 32. Yesterday it was at 35. Anytime CNN Fear and Greed Index is in fear, you want to be buying that if you are in a bull market. Last I checked, we were still in a bull market, and really all your indicators are looking bad. Market momentum is fear, stock price strength, extreme fear, stock price breadth, extreme fear, put and call options, greed, market volatility is neutral, safe haven demand in fear, and junk bond demand also in fear. Now, my favorite indicator, the percent of stocks trading above their 50-day moving average, is down 6.5% today. So 6.5% of stocks are falling below their 50-day moving average today alone. 32.69% of stocks are trading above their 50-day moving average. This is the same levels that you were at August 5th of 2024. Markets bottomed on August 5th, and we rallied 22% to where we are today from that level. Okay, the last time we were this low before then was in April of 2024. S&P had a drawdown of about 7%, and both of which times were the precise moment you wanted to be buying. Now, if we enter into a bear market from here, then obviously that's not the case. Like 2022, we kind of hit low levels. You would bounce a bit, bear market rally, come back down lower, right? If you're in a bull market, you want to be buying something when 30% of our markets are in an uptrend and 70% of our markets are in a downtrend. That's where we are right now. 70% of stocks are in an active decline. I think like 30% of our markets are in a bear market. Okay. Or 30% of stocks in our markets are in a bear market. You want to be buying that weakness when you get that opportunity. Not too often do you get this kind of weakness in a bull market. Now, same is kind of true for the AI Investor Sentiment Survey, although it could get a little bit more bearish. On December 4th, 48.3% of investors were bullish. Today, 37.8% of investors are bullish, so that's down 11%. The amount of bears jumped from 30.7% to 34.1%. The historical average is 31%, so you're 3.1% higher on your bearish side than your historical average. Okay, so, this could get more negative, but putting all of this together, you want to be buying the crap out of this. And small caps, dividend, value, healthcare, right? Those are the areas you want to be buying. Not, I repeat, not in big tech. I'm not a financial advisor. I'm not a financial planner. I'm not a fortune teller. But big tech is not where the opportunity is next year, in my personal opinion. If you don't agree with my opinion, maybe you will value Tom Lee's opinion a little bit more. So take a listen to what he just said.
With the broader markets for now, Santa Claus rally kicked off Tuesday, gaining more than 1% on Christmas Eve for the first time since 1974, and erasing December losses. We're actually positive now on the month. Let's see if it can continue. 86% of respondents to CNBC's Delivering Alpha survey forecast more gains ahead for big cap stocks in the new year. Tom Lee, Fundstrat Global Advisors co-founder and managing partner, joins us now to break it all down. So you've been right on the direction of the market for a long time now. Tom, you think the gains continue?
Yes, I think that there's a lot more tailwinds building for markets in 2025 than have existed in 2024, mainly because, now we're not worrying about the Fed worrying about inflation and bringing a halt to the economy. We have an election that's behind us, and now we have a lot of cash on the sidelines, and I think companies finally having more courage and what I think we'd call animal spirits and a willingness to start to do mergers and other things that, like capital markets, that actually help stocks next year.
But, and we were just talking about this, Treasury yields at the highs of the year, dollar at the high of the year. Those two things have acted as headwinds for stocks in the past.
Yes, I mean, that's been a foil for markets to an extent. To me, I think yields, even at around 5%, still aren't really that damaging to markets because that means you're paying 20 times for a 10-year bond. And in some ways, I think, it's not clear why yields have been rising. It could be inflation. It could be the robust economy. It could be markets concerned about, the incoming administration's policies around tariffs, et cetera. So it is something I'm watching, but I don't think it's a foil even at 5%.
Tom, first off, Happy New Year. Good to have you on. How much is the rest of the world's problems benefiting the United States? Sarah kind of alluded to it at the top, which is this is the place to be. The reality is the United States is the greatest economy in the world. The entire German DAX, their Dow Jones Industrial Average, you add up all the biggest companies in Germany, you total them all together, they are not as big as just Apple or Nvidia by itself. How much has Europe's woes, China's woes, how much has that benefited the U.S. economy, benefited the U.S. stock market, if at all?
It's hard to link causality. For a long time, as you know, outside the U.S., most of the rest of the world is small and mid-cap stocks. I think 95% of all listed stocks outside the U.S. are small and mid-caps. And I think it's the U.S. has really seen companies make the bets in the right places. U.S. dominates technology, healthcare, and financials. Those have really been the strongest industries and the ones that benefit from technology, and the U.S. edge is enormous, right? Outside the U.S., are there thousands or dozens of great technology companies? There really aren't. So I think in 2025, however, if industrials start to do better, then I think Europe and Asia start to outperform. But I think if it's a tech-led market, it's really going to be U.S.
Do you worry? We showed some of these gains, Tom. Listen, you're Tom Lee. You don't worry about a whole lot of things. But I would say when we're looking at stocks that are up 550% and 300%, okay, there are paradigm shifts which will bring in a lot of money to new things. Is there any part of Tom Lee, not the drummer, that does worry that things are a little bit hot at 40 times forward earnings on many of these, like an Oracle, a name that we didn't talk about much for years?
At some point, valuation becomes a liability when the market isn't able to be surprised or the market has overpaid for future growth. But to me, the last couple of years is really a story where investors have been underpaying for technology and the amount of innovation. I think 2025 is a year where we're going to find the AI and a lot of these applications actually do sort of re-architect the way America does business, and it's vastly cheaper, and that's why these companies are doing so well. But you're right, Brian. At some point, it's a bubble. I don't really think that that's the word yet, because I don't find that much ebullience in our clients. I think our clients are still pretty skeptical about valuations, which is why I think valuations aren't really a problem just yet.
One point I'll just raise on the skeptical note, which is on the call for small caps, Tom, which a lot of people were on the small cap bandwagon this year, and there were times where that really worked, but I don't know if December's a preview of what's to come. Small caps are still down 7% in December as the S&P has gone flat. NASDAQ far outperforming on the year, the small caps. Everyone hoped this was the time where the rally would broaden out, but then when the Fed pared back how many rate cuts it was going to get next year, small caps didn't work. So what makes you think that this will be the year?
Well, that's a really fair observation, Sarah. Small caps really are probably the best expression of when they believe the Fed is cutting for the right reasons, and there was a rug pull in December. I do think your viewers have to keep in mind small caps may not have hit escape velocity yet, but their underperformance for the last decade is 91 percentage points versus the S&P. It's the second worst 10-year underperformance since 1998. And then before
that's
that,
not necessarily bullish. I mean,
well, actually,
right
it is very
reasons,
bullish,
right?
Sarah. It's super bullish because if you go back to 1900 and use FAMA data, it's the second worst in history. If you take the three worst instances, never have small caps underperformed the next 3 years or 5 years. So what we've done is essentially discounted so much bad news. There's so much skepticism. I think almost everybody that talks about small caps says, well, they haven't worked, so they're not going to work. They're trading at a 10 forward PE. They're going to benefit from deregulation. 49% of small caps are cyclical stocks, which are really primed to do well next year. So I think that the probabilities for a very good year are high at a time when skepticism's high. I mean, isn't that what FANG was at the start of 2023? I remembered how many people said, put a fork in FANG at the end of 2022. They're done. And they just put in the two best years I think anyone could have ever expected.
So, ladies and gentlemen, that's really it, okay? You're seeing tax loss harvesting in the broader markets. It is slowing down as we head into the end of the year, but that is a drag on markets right now. And Wall Street just woke up today and said, maybe I don't want to be heavily allocated into big tech heading into 2025. Maybe that's not the best area to be in. So I think once we get into 2025, once you actually start to see some repositioning for 2025, you will start to see a broader market rally. This, I think, is the first stage or first step to get you to that broader market rally. So I actually think today it's actually bullish. I don't think this is the start of a larger crash. You are already so negative. Almost 70% of stocks are in an active decline. I just don't see what changed today. Nothing changed today. I think it's more just tactical. Okay. So let me know what you guys think about this down below in the comment section. Ladies and gentlemen, have a fantastic rest of your day and weekends. I will see you in the next one.